Welcome, welcome, welcome to the FOMC rate decision for March. We're about to see if rate cuts get cut or not. Likely not going to be cutting rates. So we're going to see what happens here today. Should be a pretty exciting day now at 2 o'clock. And then in 30 minutes from now, we will see Jerome Powell speak. So that'll be interesting. Welcome. Thank you for being here. Thank you for being here, guys. Here we go. Everyone. All right. There we go. Sharing our links to the team. We got 3 minutes. 3 minutes. I'm going to share this with our Investing for Beginners community. There we go. QQQ is at $600 currently. $600 for QQQ in the overall NASDAQ market. This could really affect the markets, guys. Let us see how bad the markets can potentially sell off or push up for no reason at all. So we'll see what happens here. We actually made a couple of dollars today, nothing crazy. MSTZ locked in just shy of $30 as MSTR was selling off and Bitcoin was selling off. Now it looks like Bitcoin is trying to find support around 71,000. It's now up to 71,600. So I went the other way. I bought ARA at 914 for a nice push up. QQQ is down 0.5% right now. So we'll see what happens here today. Excited to be here. Got the live chat on, so if you want to comment your thoughts or ask questions, you do have to be a subscriber to the channel to participate in the live chat, but that's easy. It's free, and all you literally have to do is just simply hit the subscribe button. Here we go. Got 30 seconds. 30 seconds. Let's see what happens. Right, getting it all set up here, and all right, we're at 12 o'clock. 12 o'clock. Here we go. Here my oh man, QQQ pumping slightly. All right, initially pretty good. 690 seconds. Friendly reminder, I do trade live every morning with our LTE team. If you guys want to join and check it out, if you want to tune into these live sessions, all you have to do is click the first link in the description below, and that'll give you access to those live streams. Right. Let's see. Markets want interest rates to be cut, but there's only one rate cut projected to be cut for 2026. But, okay, interesting. Hope you guys are all having a great afternoon. Okay. Rate decision should be out now. Let's go ahead and take a look. 3.75% on the rate decision. No change. No change in the rate decision. Okay, NASDAQ market's trying to push up, but doesn't look like it's doing a very good job. You can always check out our rate decision in our trading tools, which we do offer on our website. Let's see here. Today is Wednesday. Apply. There we go. Selling off slightly. Now, core PPI was slightly higher at 0.5%. Expected was 0.3%. You guys can check that out right here. Investing for Beginners community under trading tools. You can see our real-time economic calendar here. Core PPI at 0.5%. Core PPI year over year 3.9%. Slightly better than expected. And interest rate projection 3.1, 3.4 right here. Federal interest rate decision right here 3.75, so no change. No change. And then we have the FOMC press conference in 27 minutes. Okay. So no change as far as that goes. And we already knew this was going to happen. We already knew there was going to be no change. That was obvious. They're saying one rate cut in 2027 as well, so that'll be interesting. 27 minutes to spare while we wait for the FOMC meeting. If you guys want to break down some stocks, let me know, and we can do that for you guys. Share some tickers in the live chat, and we can break them down. Let's see, where's Sound at right now? Sound on the 1 hour looking decent. 4 hour, we're waiting for that nice little pump back up. It's pumped a few times. We're going to see if we get another pump for Sound. Hound AI pushed from $7.15 up to $8. And then, of course, got rejected at $8, which is fine. But a common resistance would be right around $7.70. I'd say $8 now that it did pump up to $8, so we can do that. $7.99. Yeah, let's go $7.97. That's where it popped, right? So we'll see if it can push up higher. We got a couple of shares, nothing too crazy. I'll add more when needed. SoFi, kind of holding, kind of flatlining around $17.50. It did drop to as low as $16.48 yesterday, and it's been as low as $16. So that's interesting to see here. We're going to go ahead and take this out. 16 is support. Love to see SoFi, of course, pop up, but doesn't look like it's doing much right now. Marvel popped from 75 to 95, or from 70 to 95. Very beautiful for Marvel. We call this out on a Sunday Stock Talk. Netflix from 75 to 100. We also call this out on a Sunday Stock Talk. We host them weekly. Nvidia trading horizontally. So lows of 170, highs of about 190, 193. Amazon 196 to 211 from highs of 250. Not much going on with Apple or Google really. Tesla trying to hold around 400, but it's been having a tough time these last couple of weeks. Microsoft also below 400. Got a 380 support, but getting held down by the 200 moving average. Meta trying to hold above 620. Even trying to hold just above 600, honestly. QQQ, not much happening with QQQ, right? Pumped up for just a second due to no interest rate cuts. So it's not getting worse. It's not getting better, but it's about the same. But QQQ pretty much flat the whole day, just trading sideways. Let's see what Bitcoin's doing. Bitcoin's pushing. All right, beautiful. We figured it would. After a long period of consolidation, we were actually able to trade this today and short it from this high to this low. We were able to short it by trading MSTZ, lows of $8.82 to highs of $10. Not too bad. We missed majority of the move, but we got to trade it nonetheless. Got 100 shares of Mara, thinking Mara could potentially push up from around $9 to potentially, maybe $9.50, maybe $9.80. I'd love to see $10 again, but we are holding Mara now as Bitcoin begins to curl over and push up. Love to see it. And don't mind holding Mara a little longer. Would have loved to get an entry around $9 today when it dipped. At one point where it would have been up $30, but I think we're up like 20. Not bad. And now just holding this probably overnight, potentially. MSTR selling off from highs of 152 and 150 overnight hours to lows of 140. So MSTR is down 5%, which I love to see. Don't mind this selling off at all. Could always buy more MSTZ when it makes sense. But Bitcoin looking really good, looking really bullish. See if that holds up. QQQ trying to hold above the moving average for the first time today. It's been below the moving average, and for the first time today, it's actually above the moving average and trying to hold above it for some upward momentum. So we could see it. And let me know if there's any stock tickers you want me to go over while we wait for the FOMC, while we wait for Jerome Powell to speak. In about 20 minutes, he will speak and we'll watch that. But right now, not really a lot happening. Not really a lot happening right now. Let's see. Not much is happening here with the market. Sort of flatlined for the moment. All right. Looks like we are seeing some selling pressure, some slight selling pressure on QQQ. All right, we're just waiting for Jerome Powell to speak. Yeah, okay, here we go. There's some selling pressure now. We are experiencing some selling pressure. All right, here we go. Drinking my Coke Zero. Waiting to see what the markets do. Just waiting. Just waiting here. Let's see, I should be able to pull up the speech so we can listen to it together. I want to make sure that my audio is okay as well. Okay, we're gonna get that ready and set up here. FOMC meeting live, okay.
Spring, the unofficial.
Oh, there we go. All right. We're gonna do a test on the sound here. You can watch it kind of from here if you want to. Yeah, I think that looks good right there. 230. Open panel. There we go. So how does that sound? Cool. It sounds okay, right? Yeah. Sounds okay. All right, so this is what we're going to be looking at here in a few minutes. I'm just going to bring it over here for now until we actually do go live. We got 15 minutes. 15 minutes. And I mean, it would make more sense for this to push up, but we have plenty of room for it to sell off. Right? It hasn't been able to get above 613 for QQQ, and the moving average is weighing it down, so we could see some more selling pressure, right? 600 is usually a psychological support, but we've been seeing lows of 593 and even 583 recently. So I'm curious to see, does this sell off more? Does it begin to hold? You know, what does this actually do? So that is what we are watching today. That is what we're watching today, guys. Just waiting for it to play out. Actually stick this right here for now. I think that looks pretty good right there, right? We only really need a hero. Maybe we'll put it down here. Yeah. Order book level 2. You can watch that. Whoa. Big move down. Big move down for QQQ. All right. Whoa. Big move down. Let's see if that remains, if that holds. Whoa, Tesla is selling off. Look at this. 396. Holy moly. That was a big sell-off. Everything pretty much in the red. Google and Apple with a little bit of a selling pressure. Amazon down 2% on the day. Nvidia holding. Netflix holding. Marvel down almost 3%. SoFi is down slightly. Sound is obviously down now. SPY also took a hit, almost down 1%, down 0.74%. VIX index is slightly high too. Remember, when the VIX index is above this yellow line, or 20, that means it's more likely the markets will sell off, and there's more volatility in the market as well. So that's when you start seeing these big moves up and down, up and down. A lot of volatility in the market. We're going to take a look at Bitcoin. Bitcoin, slight sell-off here. They're down 3.65% still. A little slight sell-off from 72,000. I can see this still continue to push up. We're up $10 on our Mara position. That's nice. That is nice. Nothing wrong with that at all. Alongside our $28 on MSTZ, so up 30, 40, up like $40 on the day. Like to aim for about $100 per day. $100 to $200 a day is my goal. It's looking good. Looking good. Let Bitcoin continue to push up. We have, what, 12 minutes? 12 minutes until he speaks. Okay. All right. Let me know too, guys, if you have any stocks you would like me to take a look at. I can do that. You know what I was curious on compared to Tesla? Rivian. Rivian Automotive. So I've been seeing a lot of their vehicles on the road lately. $15. Okay. I marked this up before. A lot of markups before. Let's go ahead and get rid of a couple here. Low of 8. See a low at 1050. Looks like we saw some spike ups around this level. Looks like there's quite a bit of resistance around this level. Kind of more around this level, right? 1550s, 1560s, something like that. Oh wow, this was up to 179 at one point. 179. Holy moly. Interesting. It's just been selling off. Big swings on this one. Big swings. We'll see if it can hold support above 1550 for Rivian and push higher, or will it begin to sell off, right? Go back down, retest some lows. Looks like I'm seeing some lows most recently around 14, so it's been doing a good job trying to hold above 14 for the moment. Small horizontal pattern on Rivian. Huh, interesting. I'm going to add this to our list. I don't want to forget about it. As far as adding it to the list, kind of keep an eye on it over the next couple of days, weeks. Recently viewed. What else do we got here? Some stuff that we don't normally look at on our chart. Nike down. Nike is down. SanDisk breaking its previous resistance levels. That's interesting. Okay, making new highs. What else? Hood. Hood was a company that I was keeping an eye on for quite some time. Has a lot to do with Bitcoin. So when Bitcoin begins to rally, this will tend to rally as well. We did have it on our watch list for quite some time. Go ahead and add it back. And we actually traded this too quite some time ago. We cut our losses on it. We averaged down and then cut our losses. But still solid. I mean, I wouldn't mind buying into Hood a little bit later on once we start seeing signs of some upward momentum. Just adding to our list for, this says 2025 long or short. I need to go to my watch list and rename this 2026, right? Let's see. Let's go ahead and do that here. Watch lists. Is there a way to do it? Edit watch lists. Edit 2026. Boom. There we go. Done. 2026. There we go. What else, guys? Any other companies you want to look at while we wait for the FOMC meeting? NBIS. NBIS breaking out of its horizontal pattern very nicely, right? From lows of 80 to highs of 110, back down to around 80-ish, like 82, and back up to 110, and then broke out of 110 up to 133. So Nimbus Group, not bad. Not bad at all. USO, United States Oil, still above, still at 118. Wow. 118. HIMS had a resistance of $72 and then $44. Now it's seeing a lot of resistance around $28. Wow. With a low of $13. $13.75. Nike's not really doing much. Jeez, Nike coming to a former, area of consolidation though, around $50, highs of 166. Just previously bounced off of $51 and pushed up to 77. So I mean that's not bad. Nice little area to buy Nike if interested. Cheap could always get cheaper though. I'm gonna add it to the list. We'll add it to the list for now. Something in the 50s range. We have companies in 600 range, 400 range, 300, 200, 100. Now we got some companies in like the 80s, 70s, 50s, and then of course everything underneath that, right? 50, under 20, under 10. SanDisk, well, we just talked about this one. What else? What else? Airlines. How are airlines doing with all this going on? Down 1% today. Southwest Airlines. Highs of 55. Oof. Highs of 55. Seeing lows of 38. Like 38.50 seems to be that support level for right now. American Airlines getting cheaper. Loving to see it. I wouldn't mind entertaining the fact of buying American Airlines when it begins to push up. Right? Finding support many times around $9, $8.50, potentially now $10.26, now at $11. Could see a nice uptick to $13 again, right? Maybe even $16, maybe $18, $19. So American Airlines looking really good, actually. I'm gonna go ahead and add that to my list, and I'll add gloves to my list. Jets not too bad, right? Not too bad on Jets. WTI, WNT offshore. Berkshire Hathaway kind of trading sideways. Open Door Technologies. This is another one that we were looking at for quite some time. We even traded this before. We're going to add this back to our list as well. Open Door Technologies. They have keyless entries to see houses for sale. You literally get the app. You, I think, contact someone, and it'll open the door or give you the code to open the door there, so you can actually tour the house for sale without a realtor or without anyone actually needing you to get in, which is really cool. Webull is selling off, but I use Webull, so we're going to put that back on the list. And I've traded LUNR before. I've traded it down in the low 5s to the 15s to the 25s. I've traded it within this range here, 8 to 12. It's holding up pretty good. AMC, remember this company, AMC? It's a penny stock now. It's a dollar. AMD also looking really nice, holding up above this moving average at $200. You can see this really begin to push higher. Silver back down to $70, guys. Silver is down to $70. Would you look at that? From highs of 109 back down to 79. Whoever bought down in the 50s and sold at the 109s made money. Anyone who bought in the $100 range lost money. Lost money. That's sad. Gold.com, GLD, SPDR Gold Shares. Okay. Carvana. This is a company I also used in real life. I used Carvana to buy my Dodge Challenger. Rate cut decision in 3 minutes. 3 minutes. It looks like we added a pretty good amount of companies to our watch list. Moving forward. CoreWeave. Okay. Voyager. All right. Let's go ahead and get ready to watch and react to the Fed rate decision. Whoa. I didn't realize how many of these I actually added. I added quite a bit. American Airlines, Loves, Open, Bull, SLV, 69. Yeah, perfect. Got quite a bit in order from most expensive to least expensive. Just the way I like to kind of put my alerts for some reason, or my companies. I just like to have them cheap, so I could buy the cheap if needed. There we go. Rate decision is coming out. All right, let's go ahead and watch that. Let's see, where is it? Where is it? Here we go. All right, and I'm just going to go ahead and I will put this on, and then I'll probably mute myself while we watch the interest rate decision, and I'll monitor the quality here. Okay, so all right, here we go. We got less than 1 minute. I'm gonna turn the volume down. You should be able to hear over me, but I don't want you guys to be able to hear it twice.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. The U.S. economy has been expanding at a solid pace. While job gains have remained low, the unemployment rate has been little changed in recent months, and inflation remains somewhat elevated. Today, the FOMC decided to leave our policy rate unchanged. We see the current stance of monetary policy as appropriate to promote progress toward our maximum employment and 2% inflation goals. The implications of developments in the Middle East for the U.S. economy are uncertain. We will remain attentive to risks to both sides of our dual mandate. And I'll have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a solid pace. Consumer spending has been resilient, and business fixed investment has continued to expand. In contrast, activity in the housing sector has remained weak. In our summary of economic projections, the median participant projects that real GDP will rise 2.4% this year and 2.3% next year, somewhat stronger than projected in December. In the labor market, the unemployment rate was 4.4% in February and has changed little since late last summer. Job gains have remained low. A good part of the slowing in the pace of job growth over the past year reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Other indicators, including job openings, layoffs, hiring, and nominal wage growth, generally show little change in recent months. In our SEP, the median projection of the unemployment rate is 4.4% at the end of this year and edges down thereafter. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.8% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 3.0%. These elevated readings largely reflect inflation in the goods sector, which has been boosted by the effects of tariffs. Near-term measures of inflation expectations have risen in recent weeks, likely reflecting the substantial rise in oil prices caused by the supply disruptions in the Middle East. Most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation this year is 2.7% and 2.2% next year, a bit higher than projected in December. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 3.5% to 3.75%. From last September through December, we lowered our policy rate 0.75 percentage point, bringing it within a range of plausible estimates of neutral. This normalization of our policy stance should continue to help stabilize the labor market while allowing inflation to resume its downward trend toward 2%. But the implications of events in the Middle East for the U.S. economy are uncertain. In the near term, higher energy prices will push up overall inflation, but it is too soon to know the scope and duration of the potential effects on the economy. We will continue to monitor the risks to both sides of our mandate. We are well positioned to determine the extent and timing of additional adjustments to our policy rate based on the incoming data, the evolving outlook, and the balance of risks. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path of the federal funds rate under what each participant judges to be the most likely scenario for the economy. The median participant projects that the appropriate level of the federal funds rate will be 3.4% at the end of this year and 3.1% at the end of next year, unchanged from December. As is always the case, these individual forecasts are subject to uncertainty, and they are not a committee plan or decision. Monetary policy is not on a preset course, and we'll make our decisions on a meeting-by-meeting basis. To conclude, the Fed has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We at the Fed will continue to do our jobs with objectivity, integrity, and a deep commitment to serve the American people. Thank you, and I look forward to your questions.
Colby. Thank you. Colby Smith of the New York Times.
The path to a college degree is more affordable than you think. With Sophia Learning, you can take real college-level courses
Stemming from the Middle East conflict. Is that the right approach at this juncture? And to what extent does the fact that inflation has been above target for roughly 5 years now influence the committee's thinking around this?
So, first, let me say we're well aware of the performance of inflation over the last few years and how a series of shocks have interrupted progress that we've made over time. And that happened most recently with tariffs, and now there will be some effects on inflation coming forward. The thing that's really important that we see this year is progress on inflation through a reduction in goods inflation as the one-time effects on prices of tariffs go through the system, go through the economy. That's the main thing we're looking for going into this exercise. And we need to be seeing that to sort of understand that we actually are making progress, because on net we didn't make progress. And if you look at total inflation, total core inflation, it's about 3%, and some big chunk of that, between 1/2 and 3/4, is actually tariffs. So we're looking for progress on that. The question of whether we look through the energy inflation doesn't really arise until we have kind of checked that box. It, of course, is kind of standard learning that you look through energy shocks, but that's always been dependent on inflation expectations remaining well anchored. And I think now it's also dependent on what you mentioned, which is that broader context of 5 years now of inflation above target. We have to keep all of those things in mind, and the question of looking through when it does arise will be one to approach not lightly, but in the context that you mentioned.
And just on the S&P, can you help us make sense of why there is still a bias to cut for most officials this year, despite the upward revision to headline and core inflation and the essentially unchanged forecast for growth and unemployment? Just curious, kind of what's the genesis behind the need? What's the need for the cut?
Yeah, so there are 19 people, and so 19 reasons, 19 individual submissions. And if you notice, the median didn't change, but there was actually some movement toward a meaningful amount of movement toward fewer cuts by people. So 4 or 5 people went from 2 to 1, let's say, 2 cuts to 1 cut. And each person has individual, stories behind what they want to do. But essentially it is that, the forecast is that we will be making progress on inflation. Not as much as we had hoped, but some progress on inflation. It should come as we start to see in the middle of the year progress on tariffs, going through once and then tariff inflation coming down. We should be seeing that. And, the rate forecast is conditional on the performance of the economy. So if we don't see that progress, then you won't see the rate cut.
Thank you. Howard Schneider with Reuters. Just to follow up a little bit and to be clear, is the higher inflation penciled in here for 2026 solely the result of the oil shock or something else?
So that's going to be part of it. But, that wouldn't be most of core, right? So the oil shock for sure shows up here. Some of that will be in core as well. But yes, but no, there's also just the feeling that we haven't seen, the progress that we had hoped for on core goods. And on tariffs and on the rest of it. So for whatever reason, people did write up their inflation forecast. That will certainly be tied to events in the Middle East and the price of oil, but it's also, I think, a reflection of the slow progress we've seen on tariffs, which we believe we will see. It's just a question of how long it takes for them to get all the way through the economy, and it just takes some time.
Right. And is the lack of change in the SEPs, again, just to explicate this a little bit, more due to the expectation that the oil portion of this will pass through, or more out of concern that there is a potential blow to consumption and growth coming in the form of wealth effects with the stock market down, in the form of gas prices, diverting spending from other parts of the economy?
So I didn't get the second part of your question.
That consumers are going to be potentially diverting money to gasoline from other parts of the economy. There could be a growth shock or a redistribution of spending there that can hit consumption, wealth effects as well. I guess I'm wondering, is the rate forecast not changing because you think the oil shock is going to be temporary, or because you want to be sure you're positioned in case growth starts to slow?
So the thing I really want to emphasize is that nobody knows. The economics effect could be bigger, they could be smaller, they could be much smaller or much bigger. We just don't know. So people are writing down something that seems to make sense to them, but have no conviction. To your point, if we have if we have a long period of much higher gas prices, that's going to weigh on consumption. That'll weigh on disposable personal income, and it'll weigh on consumption. But we don't know if that's going to happen. Something quite different than that. We might have much lower than expected pass-through. So people write down, this is one of those SEPs where a number of people mentioned if we were ever going to skip an SEP, this would be a good one because we just don't know. So I wouldn't say there's a conviction that this is going to go through quickly or not quickly. It's just you got to write something down, and this is something that is that people wrote down. We don't debate how long. How do you do that? We wouldn't be able to debate what the length of or size of these effects would be. We just have to kind of make an individual statement. And also, what you've written down before you'll be reluctant to move too far away from that just because you don't know. It's so unclear what the direction from this particular end will be. Meanwhile, the growth has been solid, and inflation, the overshoot is mainly from the goods and tariffs. And, the labor market is...
trying to hold
the
above
unemployment rate, of course, has little
598.
changed since September. You have a very, very low break-even rate, apparently, for new jobs with little growth in either demand or supply. But the U.S. economy is doing pretty well. It's just we don't know what the effects of this will be, and really no one does.
Steve.
Mr. Chair, in the past, the staff has suggested that higher oil prices, they have a hit to consumption, which Howard was talking about, but that's somewhat offset by increases to domestic production. I wonder if you could talk about that dynamic, especially to the extent that how much U.S. production is happening right now.
So the first thing is there is, the original thinking, the long-standing thinking, put it that way, is that you do look through energy shocks. But as I mentioned, that's conditioned on inflation expectations and that kind of thing. So, sorry, your question was?
What the staff is saying about, and has said in the past.
Yeah.
About
So there'd be an offset.
Offsets, yeah.
So that's true. We're a net exporter of energy, right? So any effects on employment and economic activity and spending would be offset to some extent by the fact that our oil companies will be more profitable and they may even do more drilling. If you ask oil companies about doing more drilling, though, they're going to want to see, a consistent rise in oil prices from where they were before the buildup for the war, and they're going to want to believe that that's going to be persistent for a fairly long time. So they're not sitting there waiting for oil to go over $70 a barrel, and then they're going to start drilling or whatever. They're going to make a reasoned, careful judgment that we're going to have higher oil prices for an extended period of time, meaningfully higher. So I wouldn't say there's much of that happening. Not much of it happening now, but some of that could happen over time if you see that. But so the net of the oil shock will still be some downward pressure on spending and employment and upward pressure on inflation, of course.
And if I could just follow up on Colby's question, how much do you worry that, having looked through tariff inflation and inflation running above target, and looking through the oil price shock, would undermine the credibility of your commitment to the 2% target?
We have to do our analysis and think these things through carefully, but of course that's on everyone's mind. We're well aware of the history, but you don't want to overreact to that. You want to make the best judgment you can based on the facts. I don't think we're going to let it color our decision-making more than is appropriate. It's more the thought that it's been 5 years, and we've actually had, we had the tariff shock, we had the pandemic, and now we have an energy shock of some size and duration. We don't know what that's going to be, actually. And, it's one of those things where it's a repeated set of things, and you worry that that's the kind of thing that can cause trouble for inflation expectations, and so we worry a lot about that, and we are very strongly committed to doing what it takes to keep inflation expectations anchored at 2%. And I think it's important that we do that. Very important.
Nick Timoros, The Wall Street Journal. Chair Powell, you've described monetary policy as modestly restrictive. If the unemployment rate is roughly stable, inflation moving sideways in the high twos, with an ongoing overshoot in services and non-housing services, not just goods, and the economy doing fairly well as you just outlined, what gives you confidence that inflation returns to target over the next couple of years?
Okay. So I would say the rate is, you can characterize it as in the high end of neutral, or you can characterize it as perhaps mildly restrictive, even modestly restrictive. No one knows for sure, but it's in that range where it's somewhere around the borderline between restrictive and not. Remember that a big part of the disinflation we're looking for is just the runoff of when tariffs are put into place. Of course, what they do is they raise prices to some extent, to the extent those prices the tariffs are paid by consumers, on a one-time basis. And we're waiting for that process. It takes 8, 9, 10, 11 months, a year to go through the system. And we're waiting for the tariffs, which were put in place over the course of the middle part and later last year. We're waiting for that to go through the system so that goods inflation will return closer to what it's always been. I mean, it used to be, for many, many years, it was negative. And then, the year before tariffs came in, it was 0. And it's running at like 2% now. So, and so that's kind of, goods inflation is running at 2%. So that's not coming from standard Phillips curve restrictive, restrictive policy. It's coming from the runoff of a one-time thing. We also think it's important, though, to keep policy either mildly restrictive or close to that, but not too restrictive because of the weakness in the downside risk in the labor market. We are balancing these two goals in a situation where the risks to the labor market are to the downside, which would call for lower rates, and the risks to inflation are to the upside, which would call for higher rates or not cutting anyway. So we're in a difficult situation, and we feel like our framework calls on us to balance the risks, and we feel like where we are now, which is kind of on that borderline, the higher borderline of restrictive versus not restrictive, we feel like that's the right place to be.
Can I ask about core non-housing services, though? Because there are some people who think that it hasn't come down very much, if at all, over the past year. If wage growth has come down, if the labor market has loosened, why has non-housing services inflation maybe been slower to follow?
That's a good question. It's frustrating. Non-housing services they basically moved sideways for a year. They're at the same level, and we do expect that they will come down. But it's a bunch of idiosyncratic things. But at the same time, that is one of the things we should be seeing, because to your point, the labor market is clearly not a source of inflationary pressures, and that should really matter for non-housing services, but we're not seeing progress there. So we do, what we expect for next year is what we want to see for this year, rather, is continued progress on housing services, finally seeing that, the goods inflation come back down because the one-time effects of tariffs are through, and then also get some help from non-housing services. That's what we'd like to see. But it's a good question why we didn't see much of that last year.
MSTR, lower high on the day. Let's see this.
Thanks, Chair Powell. Edward Lawrence with Fox
If it
Business.
has another leg down
in December, we
for
saw
MSTR.
employment numbers revised down to negative 17,000. January revised down. February posted a loss of 92,000. Is the employment side a far greater risk than the inflation side? Because we are seeing inflation. CPI is close to 2%. PCE has ticked down overall.
It's really, I wouldn't say that. I wouldn't say that that's clear at all, that one is more at risk than the other. So you can point to the unemployment rate being stable, and, in a world where both supply and demand for workers have come down very, very sharply over the course of the past year due to immigration policy largely, a ratio is going to be a better thing to look at than job creation, for example. So, and the ratio is the unemployment rate, and it's been stable since September. So that tells you that. Inflation, you can. We're at 3.0% core. Inflation 2.8%.
Also another leg
so
down
we've been
for
above the 2%.
QQQ, the overall
number
NASDAQ
is,
market. Let's see.
0.7,
If it gets
0.8,
below
above
598
4%,
and
going
holds.
above 2% for some time. And that's a concern. We need to get back down to 2%, and we need to keep focused on that, even though we do now face some new inflation from energy. So I'd be hard-pressed to say that one of them is obviously more at risk than the other.
And if I may, what happens if there's no Federal Reserve chairman confirmed on May 15th? Would you stay on?
So if my successor is not confirmed by the end of my term as chair, I would serve as chair pro tem until he is confirmed. That is what the law calls for. That's what we've done on several occasions, including involving me, and it's what we're going to do in this situation. And while I'm at it, on the question whether I will leave while the investigation is ongoing, I have no intention of leaving the board until the investigation is well and truly over, with transparency and finality. And I would refer you to the statement that was in the Fed's brief that you all have seen, and I won't have anything more for you on that. On the question of whether I will then continue to serve as a governor after my term ends and after the investigation is over, I have not made that decision yet, and I will make that decision based on what I think is best for the institution and for the people we serve. Figuring you probably were going to set the dominoes off there, Edward. And I'm not going to have any more to say on those issues, by the way.
Thank you very much. Claire Jones from the Financial Times. People have drawn quite a few historical parallels with the current situation. We've seen oil price shocks in the past. Some people have said the first Gulf War and the Fed's response to that, where there was a focus on the growth risks, is the right parallel. To what extent would you agree with that, and to what extent do you think we're in a different place today? Thank you.
It's really hard to say until we see the situation, the actual situation. In some circumstances, that might be the right case. In fact, for example, if we do see the kinds of disinflationary progress that we expect to see due to tariffs that I mentioned, I think it's hard to say, and it will depend to some extent on the size and duration of the effects we're seeing on prices, and it will depend a lot on what we can see in inflation expectations.
And just one follow-up, if I may, just on the BLS
Big
report,
drop on
that was mentioned
222,
briefly
now
there.
below
It doesn't seem from the
598.
projections or from the comments you've made today about the unemployment rate and focusing on that your view on the labour market story, to a large part being a supply-side story, has changed, despite the quite negative number in February. Would that be the right take, and was there anyone else in the room who thought differently, and that the February jobs report was cause for concern?
So I think you have to take the two together. In a way, the January report was a positive surprise, and the February report was a negative surprise. If you put them together, you get something in the middle, and I think you have to really, as you do, I'm sure, realize there was a strike and there was weather.
Bitcoin also
The way
dropping.
you see an idea in your mind and shape it into something
That suggest a degree of stability. But the thing that I think a good number of people on the committee are concerned about is just the very, very low level of job creation. If you adjust what has been the trend job creation over the past, let's say, 6 months, if you adjust that for what we think, our staff thinks, is the overstatement due to overcounting, effectively there's zero net job creation in the private sector. But actually that looks like that's about what the economy needs in terms of dealing with very, very low, non-existent, really, growth in the labor force, which, of course, we've never had in our history. So you've got a sort of a zero employment growth equilibrium. Now, that's balance, okay? But, I would say it does have a feel of downside risk, and it's not kind of a really comfortable balance. So, we look at that, we see it, we get it, and I mean, everybody understands the arithmetic, and that's you can say the break even is zero, but nonetheless, it's something we're watching carefully, and are concerned about. But ultimately, though, you can argue that it's a consequence of deliberate policy, which is really the changes to immigration. That's the biggest factor there, and but nonetheless, something we watch carefully.
Andrew. Thanks, Chair Powell. The economy's experienced a series of supply shocks in the last few years, COVID, tariffs, 2 oil price shocks. Do you think that is bad luck, or has something changed in the world that makes supply shocks more common, and does the central bank need to start taking account of the risk of supply shocks as a more common problem?
You know, we did go through a long period where the shocks were all demand shocks, and you know, so we've had a lot of practice thinking about supply shocks in the last 4 or 5 years for sure. And it's just a very different thing and a very much more difficult thing, because it does immediately raise the question of tension between the two parts of our mandate. But, you know, has the world changed? I mean, COVID is a one-time thing, right? This energy supply shock is a one-time thing. It's not because of some broad tendency or anything, I don't think. And you know, the oil shock with Ukraine was also a consequence of military action. So I don't know that the world has changed in a way that there'll be more supply shocks. But you know, people have written that paper and that speech a number of times. A number of people have tried to make the case that that is the case. And in fact, we have seen more supply shocks in the last 5 years than we've seen in many years before that. It's a fact.
Okay. You said last year that the Fed was reviewing its communication strategies, including the SEP, as part of its framework review. Whatever happened to that? And I have like 5 follow-ups to that, but you know, I guess, you know, what would you change about Fed communications if you had the time? Thanks.
What happened about that was not much, and I'll tell you why. So, you know, we looked carefully at many aspects of the SEP and of our communications, and there weren't any ideas that had very broad support on the committee. And you don't want to make a change to your communications unless you have the committee behind that. So we didn't really make any changes on that. I had hoped that they had some things that I wanted to do, but they didn't attract broad support, and we'd already made all the changes.
Bitcoin all the way
So
back down to
that was a critical
71,000.
thing.
Giving back everything gained today.
I wish we had been able to do some things, but you know, we didn't. So maybe the next chair will take a look. I'm sure he will.
Michael McKee from Bloomberg Television and Radio. The minutes show in January some members of the committee wanted to include a two-sided guidance on policy. Was that discussed today? And given the rise in the inflation expectations, how much support for a two-sided policy?
Down to 597. Let's see if we get another leg down.
It did come up today. The policy that the possibility rather that our next move might be an increase did come up at the meeting, as it did at the last meeting. The vast majority of participants don't see that as their base case, and of course we don't take things off the table. But you correctly characterized, what was in the minutes that several participants indicated, and something very much like that conversation did happen. What was your second question, though?
I was just one question there, but follow-up would be, there are a lot of goods besides oil that are trapped in the Strait right now, and a lot of supply chains getting snarled. How much concern do you have about whether, if this becomes an inflation problem beyond just oil, whether there's anything you can do about it or would do about it, given the efficacies of monetary policy?
You know, you can worry about other commodities. You can worry about all of the ways that oil-related commodities go into manufacturing and that kind of thing. The truth is, it's completely out of our hands, and we just, like everybody else, we have to just wait and see what happens, and it'll come down to how long the current situation lasts, and then what are the effects on prices, and then how do consumers react and that kind of thing. Really, I wouldn't speculate in any way, and there's really not a lot we can do other than kind of watch and see.
Maria Luisa.
Afternoon, Chair Powell. Maria Luisa Capurro with Bloomberg News. I wanted to ask you, you've said longer-term measures of inflation expectations reflect confidence that the Fed will get back to its 2% goal, but there are some colleagues of yours who have pointed to higher dispersion in household service, in business service as well. So, and that they take as a signal that inflation expectations may be less sticky than in the past. I'm wondering if there was a discussion around that at this meeting across the committee, and what were the views of what is the state of inflation expectations and the risks from higher oil and gas prices.
So at this meeting, I mean, a number of people mentioned and staff briefed on short-term expectations having moved up quite a lot for reasons we understand well. But long-term expectations, you know, you can always find one that's troubling or some aspect of one that's troubling, but ultimately, right through this whole period, the overwhelming majority of the things we look to, including markets, including surveys of, you know, of the public and also of forecasters, they've all been pretty solid on longer-term inflation expectations being right where they need to be, consistent with 2%. So that continues to be the case. We didn't have a lot of conversation about that. I think everyone does agree that you know, we'll be watching those extremely carefully as we see the effects of the price increases come through from the conflict.
And still on how the discussion went across the committee, before coming to this meeting, there were some members who were like discussing the risks of a slowdown in growth and at a time of where inflation remains high. It really doesn't seem that most.
All right, guys. So it looks like there's going to be another few minutes of questions, but we got the gist of it. We've been live for an hour, and so, you know, to wrap things up, the Fed is not doing anything different than what they've been doing over the past few weeks. I mean, there's not a lot going on. A lot of people are celebrating that the markets are selling off, but at the same time, I'm happy whether it's up, whether it's down, because we make money daily. We don't have any open positions that are really going to affect my portfolio balance. And that's really just it. If you guys want to continue watching, just look up Jerome Powell live. But if you look at QQQ, it looks like 595 is around, you know, general support, right around this level. But I mean, pretty common support level. And 913 is a pretty strong resistance. We could see this begin to push higher. We can see this sell off. But, you know, bigger picture, you can see very clearly where the market bounces as far as support and where it sells off as far as resistance. At the end of the day, you know, we're all here to make money. We're all here to do our best part in locking in profits. And I want you guys to understand that, right? I want you guys to be able to have more informed decisions on when to go long, when to open a short, when to take profits, when to cut your losses, right? And it's nothing new. Markets aren't making new highs. They're not making new lows. They're basically just trading within range, trading horizontally, horizontal pattern, trading sideways, however you want to say it, but that's what's happening, okay? And I want you guys to be aware of that. So QQQ, not really doing a whole lot, right? We can see this become more bullish, maybe more bearish. Same thing with Bitcoin. Bitcoin seems to be kind of hovering around this level as well, right? You see very easily common support levels, common resistance levels. And so I'm excited to see what happens throughout the end of the day. You know, Trump could make a tweet and we can go back up, right? Who knows, right? Who knows? But just make sure you have a healthy habit of having a stop loss, trimming your position when it makes sense, taking profits, and not being afraid to sometimes hold cash if you need to hold cash. In times of uncertainty, sometimes the best position to take is no position at all. You can't lose money if you have more cash. You can't lose money if you're not in a trade. Do not become a bag holder. Do not hope for a green day. Do not hope that your trade plan is going to go the way you want it to, right? Our job is to not to predict the market. Our job is to reduce our losses, to minimize how much money we lose. So always trade with the stop loss, always have a trade plan and know when to take profits. I'd rather take profits sooner than later, and that is how you win. That is how you grow your accounts. And guys, if you want to join our Discord community, watch me trade live in the morning at market open, and overall hang out and get to know other traders that are doing the same thing, and that's trying to learn how to be more consistently profitable in the stock market. Click the first link in the description below, and you'll get access to all of our live morning day trading sessions, access to our A to Z Learn to Earn lesson library, and a community that's growing faster than ever before. So thank you for your time. Guys, I hope you guys have a great rest of your day, and we will see you all for tomorrow's live day trading session at Market Open. Later, team.